Do you want to know how you can buy real estate using none of your own money with no down payment? By the time this video is complete, you will have one new technique at your disposal that you can use to buy properties with no or very little money down. Yes, today we're talking about subject twos. First of all, I'd like to salute you for taking the time, for putting forth the effort to improve your financial situation. Financial education is the number one thing you can do to improve your financial situation in life. I am Randy Perez. I'm a 21 plus year real estate investor as well as stock and option trader. And when I trade stocks, I like to trade dividend stocks. Today we're going to talk about one of the techniques that I used in the recession when my credit was really banged up. It had been really messed up from the financial challenges of the recession. And I used this technique, subject twos, to acquire properties that have changed my life forever, as you're going to see. We're going to talk through one of my deals that I did. You're going to see all the numbers, including the HUD, the cash flows, as well as the cash flows over the past 10 months since I paid this house off last year. I think this will help you realize how powerful subject twos can be, and it'll give you one more tool to have in your tool bag to do more deals starting today. So let's get started. First, what is a subject to deal? A subject to deal is simply when you buy a property from a seller and you buy the property subject to the mortgage they currently have on the property. Well, what does this look like? Well, a typical scenario is where a seller contacts you, or maybe you find a seller who's open to some type of creative financing, but the seller has a mortgage in place. Typically for me, this scenario looks like this. I run numbers, but the price I come up with as my cash purchase price is lower than what they owe. At that time, I immediately switch over to see if a subject to deal is possible with this seller. So typically they owe more than I want to pay. But the sweet spot for me is that I can buy this property with little or no money down. So I will buy the property from the seller. The mortgage will stay in place. It will stay in the seller's name until you either pay it off, refinance it, or sell the property. So the mortgage does stay in the seller's name, but I, the investor, you, the investor, buy the property. You take on full responsibility, headache, liability of ownership. The owner is truly complete with the property. The property is no longer in their name. However, the mortgage does stay in place and it does stay in their name until it's paid off. Well, what are the good aspects of doing a subject to from the seller's perspective, not from yours? From yours, it's great because you are not on the hook for the mortgage, but you now control the property. But from the seller's aspect, what do they get out of it? I find this scenario works best when the seller is done with the property. Whether it's financially, they can no longer afford the property, maybe mentally, maybe emotionally, whatever reason, there's a disconnect there and they no longer want anything to do with the property. They're throwing their hands up. Maybe the property needs a little bit of work, maybe it doesn't. They just want to be done with it. Typically, this tool, subject to deals, is done when a person has begun to fall behind on their mortgage. So letting someone else take over the mortgage, to take over those payments, actually may improve their credit situation since their credit is currently getting damaged by not making payments or by being behind on the mortgage. Another positive for doing a subject to from the seller's perspective is that as an investor, I'm willing to pay more for that property. Many times those loans have lower interest rates. They're also fixed for the life of the loan. There's no adjustment, which investors, as you buy more properties, you'll find that most loans have a balloon or adjustment period. Well, that's not the case on a 30-year loan. Also, the seller is done with the problem. They no longer have to deal with this property. They can move on with their life and get rid of that stress. Another advantage is that me as an investor, I'm willing to pay more for that property. I don't have to come out of pocket for the purchase price, for the closing costs, and for the fix-up price. Only for the closing cost and for the fix-up. I no longer have to worry about coming with all that money to buy the property as my purchase price. So for me, I'm willing to pay that seller more for the property than if it was a cash deal, thus enabling them to sell to me when it's not a property I would ever be interested in cash-wise, and I'm able to buy a property that I would not be able to buy as a straight-up traditional cash deal. So now that we've discussed the positives of a subject to deal, let's discuss the potential negatives. First of all, the seller is relinquishing control of their credit score. What I mean by this is that if you as the investor begin to fall behind on those payments, well, it damages the seller's credit, not your credit, because your credit is not tied to that loan. However, if the seller is already behind their payments, they really have nothing to lose, especially if they are starting down the path of foreclosure. You taking over their mortgage can actually then become a positive because it will improve their credit and save their credit from taking that big hit that it would take if the property was foreclosed on. Another potential negative for you as the investor and possibly the seller is that all of these loans contain what's called a due on sale clause. That means the lender can call the loan due or demand the loan be paid off if the property is sold, which it is going to sell because we are buying it. So they can call that loan due. However, it's my experience of over 2 decades that these loans are not called due very often at all. In fact, over the past 20 years, I've only heard of a friend who had a loan who was called due. But know that if the loan is called due, you have to pay that loan off within a relatively short period of time. Another potential negative is that you may have to double insure this property. Well, why is that? Well, typically these sellers have their insurance and taxes escrowed, so you make that payment along with the monthly payment. Well, in this scenario, your name is not on that policy. So unless you get this seller to sit down with you, make the phone call, add your name to the policy, then you will not have insurance in case of a fire, a storm, or liability unless you get your own policy. Now, some of the investors that I work with, they have spent the time to meet with the seller face to face, call the insurance company, and in fact cancel the policy and open a new policy with the new buyer's company name on it as well as the seller's name, and then present that new policy to the mortgage company so they have proof of insurance. That would save you having to get a double policy and would decrease your expenses. But just understand that if you don't get your own insurance policies, then if something happens, if the house catches on fire, if a storm blows the house away, or if there's a liability lawsuit, you are not covered unless your name is on either your own insurance policy or the insurance policy that's in place currently that's being paid through escrow. One other important piece of information you want to always keep in mind is that these payments with these mortgage companies, these escrow amounts, those amounts can change, and typically they do. Usually not by much, sometimes by a lot of money. But you want to make sure that the statements are mailed to you or that you have access to view them online. That way you know if the mortgage payment changes. You see, if you don't know that that payment changed, and it changes by just 1 penny, it's 1 penny more than it was last month, then all of a sudden you're still paying that old payment, and that 1 penny you're off could cost that seller dings on their credit. So you want to make sure those statements are mailed to you, the investor, so you know when you need to adjust your payment. Well, let's get into an example of how you can do this. Let's look at an actual deal. Let's review the numbers of a house that I bought within the past 5 years. That was a true subject to property with no down payment and very low cost to buy it as a result of just paying some closing costs. As you can see, the cost that I had to come out of pocket at closing was only $985.30. So truly a no down payment deal with very low costs to enter into this deal. Now first, I want to direct your attention to the slide here that shows the past 10.5 months cash flow. The reason for this is that I was able to pay this loan off last year. And I want to show you what can happen once you begin to get properties like this paid off. If you notice there, we brought in a little over $13,000 over the past 10.5 months. Our expenses have been very low. We spent some money fixing this property up, so our maintenance should be low for the foreseeable future. The result is that we have pocketed almost $13,000 cash flow in our pocket since January of this year. Now remember, we paid this mortgage off, so there is no mortgage payment now. Whereas for the first several years, we did have a mortgage payment. On this next slide, you're gonna see the complete cash flow from day one to present on this property. As you see there, we brought in almost $73,000 in rents on this one property. If you notice at the bottom, the very bottom, that negative $53,518 Well, that's how much we're out of pocket. And the reason for that is that we paid this loan off early. About 11 months ago, we paid the loan off and the balance was approximately $58,000 at that point. So you can see this was not a tremendous cash flow deal, but it was a deal that we were able to do. And then when we came into some money down the road from flipping some houses, we actually paid this loan off, and you'll see the returns that we're receiving now because we're able to buy a property that we would have walked away from, but we were able to put a deal together that was a subject to deal on a property that we would never have touched if it was initially a cash deal. So let's see what's happened with this property. This next slide shows the cash flow over the complete time we have owned this property, approximately 5 years. Now note that it does not include paying the loan off. If you take out paying the loan off, then we would have brought in $14,900, so almost $15,000. So let's review these returns. So remember, we initially came out of pocket $985 to purchase this property, this subject to deal, and that was all closing cost. Well, if our estimated annual cash flow, now that the loan has been paid off, is $14,000, that produces an excess of 1,400% annual return once this property is paid off, like it is now. All this on a deal that we would not have done if we did not know about this technique of buying properties subject to. Well, now let's play with some numbers. What if you have 10 of these guys? What if you're able to pick up a house a year or a house every other month and eventually pay them off? How would that affect your life? This is exciting stuff. Notice that if you're gonna receive $14,000 a year in annual cash flow, multiply that times 10, your annual cash flow from owing just 10 houses like this and getting them paid off, your annual cash flow would be $140,000. Let's take it even farther. What if over multiple years you were able to acquire 100 of these and then over 10, 15, 20 years pay them off? Your cash flow would be $1.4 million a year. Forget becoming a millionaire. Let's make $1 million a year. That's what knowledge like what you're acquiring today can do for you. It can turn you not only into a millionaire, but a yearly cash flow millionaire. So do you see what adding one more technique like this to your repertoire, do you see what it can do for your financial future? But how do we talk to sellers about doing a subject to? What do we say? Well, I'm gonna get into that in just a moment. But before that, if you're finding value in this video, please consider hitting the subscribe button, as well as the notification bell. That way you get a notification every time we have a new video that comes out. This channel is committed to helping you learn how to build multiple passive income streams. Income that you work for one time, but you get paid for forever. My goal is to provide awesome content for you every week that will help you increase your passive income streams or begin to get them going. But how do we talk a seller through the idea and the process of doing a subject to deal? This is a question I get a lot from new investors, as well as from those who have never done a subject to deal before. One of the important things that you want to keep in mind is you want to be very upfront and honest with someone that you're trying to do a subject to deal with. You want to be that way with everybody, but especially with someone who is depending upon you to maintain or improve their credit situation. So you want to talk through those positives and negatives with them. Tell everything to them. I have not found that this has ruined any of my potential deals. In fact, my honesty and my upfrontness typically tends to receive a compliment from the seller. They say, "Thank you for being honest with me. Let me think about this. Let me talk about this with my spouse, and I'll let you know." But being honest and upfront is never a bad thing. And it typically results in them trusting me more because I tell them the goods and the bad part of doing a subject to deal. Now, it's important that if you do a subject to deal with the seller that they not contact their mortgage company. This is the one big negative for you. This loan can be called due. If it's not thrown in their face, then almost always is not. There is a slight possibility, but if it is thrown in the mortgage company's face, it's a lot more likely that they may call that loan due. So educate your seller that you do not want to let the mortgage company know that you're selling the property. So now you have your new tool. What are you going to do with it? Well, let's go out and use it. Let's go out today and begin finding sellers that have property for sale that have mortgages that you can do a subject to deal with them today. And then you're looking at many properties. You'll find people that have a mortgage, maybe they owe more than what you'd be willing to pay for it cash. That's a perfect scenario to ask them, are you open to subject to financing? Can I tell you how that works? You can decide for yourself if this is something that's good for you. Put it out there to everyone. All you can get is a no, and we can all deal with getting no's, can't we? Especially if we get some yeses, which you will. In our next video, we're going to talk about how you get started. Recently, I've had a lot of investors ask me, well, how do I get started from day one? Well, I was there over 20 years ago, and in fact, after the recession, I had to kind of restart my portfolio. So I have been there not only just once, but also twice. I'm going to tell you how you can start from day one, the steps you need to do to be a successful real estate investor. That's what we'll discuss in our next real estate video. So consider hitting that subscribe button as well as the notification bell. That way when the next videos come out, you'll get a notification right into your email. Also, if you enjoyed the video, if you found benefit, please hit the like button. Those things are small, but they do motivate me to continue making videos such as this one that can improve your financial education, as well as help you create passive income streams that work for you while you're sleeping, while you're hanging out with family, while you're traveling, or if you choose to, while you're working another job. So until next time, happy investing, and we'll see you again soon.